Hello and welcome to the Global View on this Wednesday. Well, let's take a look at what's going on at a macro level. US 10-year Treasury yield slightly higher, while market participants view that more foreign dollars will turn to the safe haven of US Treasuries if the Middle East conflict expands. The yield on the 10-year note at 4.85% and the 2-year up more than 5 basis points at 5.1%. US business output increased in October as the manufacturing sector pulled out of a 5-month contraction on a pickup in new orders, while services activity accelerated slightly. Whereas in the Eurozone, business slipped to its lowest level in 3 years as demand fell in a broad-based downturn across the region, suggesting the bloc may slip into recession. And in the UK, activity continues to decline ahead of the Bank of England's interest rate decision next week. Well, the US dollar climbed against most major currencies on that economic data, which highlights the strength of the US economy relative to what we're seeing in both the UK and the EU. The Aussie dollar trading at 63.5 US cents. Well, as mentioned, the US 10-year Treasury yields, well, they've been moving violently recently as the market considers the prospect of interest rates remaining elevated, the conflict in the Middle East, and the growing US budget deficit. To talk us through it and the way to play it, I caught up with Joe Kalish, Chief Global Macro Strategist at Ned Davis Research.
Look, the 10-year Treasury yield has backed up about 170 basis points from its early April low of 330. And there are a lot of reasons for that. It's not just one factor. Traditionally, it would have been inflation, but inflation has only accounted for about 15% of that move. So 15% of that move has been due to inflation expectations. What's really happened is there's been better growth. We're going to get the official numbers in a couple of days from now, but really what we're looking at is probably a GDP print of 4.5 to maybe 5%. So that's quite strong, and as a result of that incredibly strong economic performance, the Federal Reserve said that they were going to do 2 fewer rate cuts next year. So if you're not going to cut as much, then the long end couldn't continue to go down. So that rallied up. And on top of that, we've had continued supply coming from the Fed. They're still running off $60 billion a month in Treasury securities. And then we have this seemingly endless supply of Treasuries coming from the US government. So that's another thing. And then we have Japan tweaked its yield curve control. That was good for 25, 30 basis points to help push upward pressure on global bond yields, which Treasuries have to compete with. And I think the final factor is just all the political dysfunction. I think we still don't have a House Speaker. We could be facing another government shutdown in less than a month. And on top of that, Moody's has threatened a debt downgrade. So we're just not behaving like a AAA rated credit. So I think all those factors have helped push these yields back up toward 5%.
Yeah, a lot of factors at play there that you've just mentioned, Joe. And of course, given what's going on in the Middle East, you feel as though that more foreign dollars will turn to that safe haven of US Treasuries.
So traditionally that's been the case, but we really haven't seen that coming through. We've seen some dollar buying, but we've also seen buying in gold and Swiss franc. And so other areas have kind of taken over that spot in terms of safe haven bids. So we are seeing a little bit on the short end, but certainly not on the long end.
And you mentioned the dysfunction in Washington, and I guess the root of this being the budgetary position of the US at the moment. So how do you see this playing out, and I guess where that will take those Treasury yields?
So look, we're on a path right now of having budget deficits of 6 to 7% of GDP for the next 10 years if we don't change this trajectory. And so about 4 percentage points of that is what we call the primary deficit. That excludes any interest payments, and the interest payments are just added on top of that, which is the fastest growing item of the federal budget. So we've got a lot of work to do. There are some opportunities, in terms of cutting back on some of the budget deficit. The Trump tax cuts, for example, expire at the end of 2025, but nobody seems to have an appetite to have taxes go back up. But of course, we're spending more on defense. The world hasn't gotten any safer. We're spending more on interest, but there are things that can be done in terms of the social programs, such as means testing, which also seems to have been very tough to do politically. And then there's such a fine line between the majorities and as the split House and Senate. It's just very difficult to get anything through. So we're really not going to see any clarity on that before the next election at the end of next year, the next presidential election, and what the complexion is of the House and Senate. So we really could be facing quite a while before we have any degree of clarity on getting that budget deficit down.
So, Joe, if you don't, the US doesn't cut that deficit, you've posed the question: is who's going to be buying all of that debt?
Yeah, that's a really good question, because it had been since the pandemic. The Fed was the largest buyer. They're now a net seller. Banks was the second largest buyer. They're now a net seller. The third largest buyer, which is now after the selling from the Fed and the banks, are now state and local governments, which is not something people normally would think about, but we're pretty flush with cash infusions from the pandemic and fiscal support. And they invested a lot of that money into Treasury. They're no longer buying the degree that they have been. So now it's really dependent on price-sensitive buyers. So pension funds will do their part, insurance companies will do their part, but ultimately it's going to have to come out of the household sector. So that plus their proxies through funds and ETFs are really going to have to come in to buy that debt, and that ultimately could require a higher yield, and that money to come out of cash, to come out of equities and other risk assets in order to buy those bonds. So there is a level. It's just finding what that level is.
So, Joe, from an individual investor point of view, then where's the opportunity there? I guess, particularly with your exposure in fixed income, as far as duration is concerned, what's the strategy?
The area that we're in now, from about right around current levels up to about 5.25, give you a pretty good area in terms of evaluation, from a valuation perspective. And so I wouldn't want to get too bearish in here, because there are some signs that we're not going to keep up the strength from Q3. The economy is going to slow into Q4 and into the first half of next year. So that could bring, as we get into next year, inflationary pressures back down. Could allow the Fed to come off of its peaks on their rate cycle here, and but they're still going to remain, I would say, restricted, and that just means a higher real yield. So I think there are some opportunities here for people who have a little bit longer term perspective in this area. It's not a bad place. 5% historically, given where we have come from, is a pretty decent yield.
Just in terms of broader asset allocation, then you did mention gold. What's your outlook there?
So ultimately, we like gold, and I like it over a long-term perspective. We should see a weaker dollar eventually. It's not an immediate call, but the dollar is overvalued. It was even more overvalued about a year ago. And so what's been supporting the dollar has been the higher real yields. Eventually those will come down, and that should help provide some support. But I think what we're seeing now is that there's just a different set of buyers. I call it the New World Order, and you're seeing that buying from central banks, particularly in emerging markets. That's been going on since 2008, and they've been increasing their ownership of commodities, and particularly things like gold. And I think their distrust of the Western financial system is something that I think will be supportive for gold over the long run.
And Joe, just finally, your outlook for the US dollar, it did climb overnight our time. We did have a raft of those PMIs, of course, globally, underlining, I guess, that strength we're seeing in the US with both manufacturing and services, as opposed to what we're seeing both in the EU and UK. So how's that playing as far as the US dollar is concerned?
Well, I guess as long as the U.S. economy is going to be strong and keep the Fed in play, it's really hard to see a lot of weakness in the dollar in the short term. But yeah, as we get the numbers come through, with some softer growth in the coming quarters, then we should start to see the dollar come off. I think there's also another important aspect to that is that there's an economic aspect, which you pointed out, but there's also the budgetary aspect. And Europe's still living under Maastricht rules with 3% budget deficits effectively, and the U.S. doesn't have any of those rules. So there is a little bit difference in terms of fiscal policy, but it's really hard to bet against the strong growth for now. So we need to see that cool off before we can think about the dollar sort of coming down on a short-term basis.
Joe Kalish, Chief Global Macro Strategist at Ned Davis Research. That is the global view. Just a check of where we're likely to be going in just a couple of minutes when we get underway on the local session. SPI futures currently up around 0.33%. Stay with us. The open is just around the corner.